Brilliant. Thank you so much for joining today. We are really, really excited to do this. I don't know about you, but I feel slightly overwhelmed with the amount of stuff that's going on at the moment in sustainability, whether it's negative or positive. I mean, there's a lot of good stuff and it's kind of overwhelming, but I am so pleased that I work with Emma because she is brilliant at making the complicated less complicated. And we're going to go through what is on the horizons within the sustainability world. And I don't know, it's interesting, isn't it? At the moment, we are seeing that investors are now really demanding climate impact and solid business cases from us. And the grid constraints that we're seeing because of the amount of energy that we are using is going to become more and more of a strategic risk for us. And I think it's interesting how you can look at what is going on in the world and how that is being translated into business and into what it is that we do on a day-to-day basis. And I think if companies are dependent on fossil fuels and having fossil fuels in supply chain, then you're going to face mounting reputational risk. And it's all tied in with legislation. Emma, could you go on to the next slide, please? So I guess I've just gone straight in to talk about the world and where we see it and what we're doing without introducing ourselves. Now, Emma and I have been working in the industry for a pretty long time and worked together for a pretty long time. Brilliant. And we are a part of the senior leadership team at 51 to Carbon Zero. And I would say, Emma, we make a pretty good double team. You're like the brains, and I'm not really brawn, am I? I'm that.
You're the people person.
And so today, without further ado, let's get on and understand what's in the future for us in sustainability in our respective businesses.
Brilliant. Thanks, Will. Thanks, everyone, for being here today. Here's the agenda. It's very, very simple and straightforward. Little intro, which we've done. What's going on around the world in sustainability. Little chat from Will there. Obviously, Will's got a podcast which has quite a lot of followers. So speaking to people across a whole range of sustainability, whether it's people who are really working in it or people who are on the fringes of it and trying to step into it. And we're all kind of running around like headless chickens really at the moment. So I found it really useful.
Thanks.
Yeah.
And I didn't mention that just now, did I? And I probably should have done the podcast. And I started doing weekly insights as well into what's going on in the news. And I'm going to be trying to digest that information and give that information back in more easy chunks.
Yeah. And I guess the kind of frameworks of what you need to do and all of that kind of stuff is the kind of nuts and bolts of everything. But at the end of the day, you have to remember why we're doing all of this, and we're sort of trying to, I guess, save the planet. But sometimes the winds that blow are not fair. So here we go. Let's dive in, see what we can find out. This is just a little taster slide. We're going to be looking at the US, we're going to be looking at the EU, Australia, the UK. Obviously, there are lots and lots of other jurisdictions as well. It'd be great to cover them all. We'll go through what we can for now. So let's dive straight in. I'm going straight in for California SB 253. So what's happened here is that CARB, which is the California Air Resources Board, has drafted up some regulations which I actually think are brilliant. And SB 253 is disclosure of climate-related financial risk. So, as Will mentioned at the beginning, the climate-related risk, I've been banging on about this to people for years, and that they kind of haven't quite got what I was going on about, because they say, oh, we're a service industry, we've just got office buildings in, you know, Sacramento or London or whatever. We don't really have climate-related risks. But I think with all the extreme weather events, and the climate-related hazards are increasing both in frequency and severity recently, people are starting to kind of get it. And at the same time, various jurisdictions are mandating that companies report this. Part of that is to cater to shareholders and stakeholders of companies. They don't want to invest money in companies that aren't addressing their risks, just like you address any other kind of business risk, whether it's FX risk, or whether it's reputational risk, or any other kind of business related risk. So what happens with SB 253, that's just a legal name, if you like. It's just a number, which is basically the clause in the state of California's legal legislation, draft legislation. So what this is mandating people to do is to report their climate-related risks, as well as their scopes 1, 2, and later on scope 3 emissions. So where must this be reported? In the public-facing company website. So wherever you publish your director's strategic report, or wherever you report your financial reports, and if you haven't got somewhere that you do that, then create a page or a dedicated space on your company website where you report your scope 1, 2, and 3 emissions. And then also a link to that report needs to be submitted to the CARB's, what they call a public docket. So it's basically just a place on CARB's website where you can submit a link. Now, the companies that are in scope for SB 253 are those with over $1 billion turnover in annual revenue, or turnover, who do business in California. So what does doing business mean? Doing business means organized or commercially domiciled in the state of California, or alternatively, having California sales that exceed a certain threshold, that 2024 figure of round about $700,000 US. So those companies must measure and report their scopes 1, 2, and 3 emissions. And this is part of looking at your climate-related financial risk. When you report your emissions, what you're really focusing on is your transition risk, because you're looking at what you're doing to the planet rather than what the planet is doing to you, which we'll come on to in the next slide. So for SB 253, when does the reporting start? So scope 1 and 2 emissions reporting has to be done by August the 10th of this year. And then from 2027 onwards, your scope 3 will also need to be included. What actions to take? Start capturing your scopes 1 and 2 emissions. Hopefully you're already doing that. And then start to capture scope 3. Publish your emissions on your company website every year. We're going to come on to the other SB 261. Now, with SB 261, I mentioned that we're going to look at the risks associated with what the climate is doing to your company, as well as what you're doing in order to transition to a net zero economy. So what's SB 261? It's disclosure of climate-related financial risks and the measures you adopt to mitigate or reduce the risks and to adapt to them. So there's going to be part of the risk that you can't completely remove, so you need to adapt. That's where adaptation comes in, and then part of the risk that you need to reduce, so sort of mitigate. Again, it's the same story. Public-facing website, put your risk reports out there, and the reports must be submitted biannually after the first year. The first year, now we'll come on to that because there's been a bit of pushback in the state of California against SB 261. So originally it was going to be the 1st of January 2026 was when your first report had to be submitted. However, the enforcement is paused due to an injunction, which has halted the deadline while litigation continues. So at the Court of Appeal. So on January the 9th, the Court of Appeal made no decision. So we haven't actually got to the point where we've got a decision on exactly what needs to happen when. However, for those companies who are in scope, which it applies to companies with over $500 million in annual revenue, doing business in California, which is the same definition as on the previous slide, they will still need to start measuring and thinking about their climate-related risks, because this will happen, because it's happening globally. So they should still prepare as CARB plans to set an alternative date later on. So start measuring your emissions, but also in line with something called TCFD. So there's going to be Acronym City going through this webinar. TCFD is the Task Force on Climate-Related Financial Disclosures, which has been disbanded, but the framework still exists and is being adopted, albeit somewhat slightly amended, all around the world. And we'll come on to that later. So in line with that TCFD-aligned climate risk reporting, there are 4 pillars: governance, strategy, risk management, and metrics and targets. Metrics and targets is probably the most easy to understand in a way, because that's where your scope 1, 2, and 3 come in, that we talked about in the previous slide, where you're actually looking at your carbon emissions as a corporate. And also you're looking at your targets to reduce, and you're also looking at your climate transition or your carbon reduction plan. So that's your metrics and targets pillar. The others are to do with, the first one is to do with governance. So who's responsible for looking at risk in your company, and how does that work? At what level, who in C-suite and who management level, and how does all that reporting work? And then basically they're the people with responsibility. You then talk about your strategy, and that's a description of how often do those bodies meet, how exactly do they decide what the risks are. So in the strategy, you describe what your risks actually are that you've identified, and your opportunities. We mustn't forget the opportunities, because with each risk, but usually comes an opportunity, and it could be an opportunity for expanding your business, expanding your service provision, or expanding your market share. But then you look at the impacts, and you look at the company's resilience in its response to those impacts. And then the risk management is the process. So how often do you look at your risk matrix? How often do you consider your risks, whether they're physical, acute, or physical chronic risks, or transition risks? And looking at all 3 types of risk, how often are they considered? How do you do this? Do you use flood maps, heat maps, etc.? And then how do you decide what's short, medium, and long term? How do you decide what the company's appetite for risk is? And how is this integrated? This is really crucial. How is this integrated into your overall business risk management? So that's California. And we're going to move on to the EU. We're doing all the difficult ones first, because, again, this is one that's had a bit of pushback and is a bit up in the air. So we've got I'm sure everyone's heard of CSRD, which is the EU's Corporate Sustainability Reporting Directive. So what the EU tends to do is they issue a directive, and then the member states enfranchise that into their national members' law. So, like, for example, we'll come on to talk about SECA later, but SECA was something that the UK enfranchised into law, and as a result of a directive by the EU, when the UK was part of the EU. Okay, so what is CSRD? It's an EU regulation, and it's an update to something called the NFRD, which is the Non-Financial Reporting Directive. But it's actually kind of expanding on what needs to be reported, and also widening the boundary of who's caught up and who qualifies for it. So qualifying companies have to report on ESG impacts based on the ISSB's IFRS S1 and S2, which is a bit of a mouthful. So the ISSB is the International Sustainability Standards Board, and as in the name, it's international. And they've produced, I think it was like 2023, they published these two standards, S1 and S2. S1 is a general requirement for disclosure of sustainability related financial information. Now, that includes non-carbon stuff, and it can include biodiversity and land use and all sorts of other stuff as well. And it requires doing something called a materiality assessment, or in this case, a double materiality assessment. Basically, what you're looking at is what is material to your company, and in what aspects of your company's operations are material to the planet and the people. So you're looking at it from a financial point of view, as well as from the actual impacts, be it carbon, be it other things, be it other environmental performance indicators. Then S2 is where it's climate related disclosures. So S1 is sort of general sustainability stuff. S2 is specifically related to climate. So who's CSRD for? So I've put here it's post-omnibus. So what happened was towards the end of last year, there was a bit of or perhaps further along ago than towards the end of last year, sort of like Q3, Q4 last year, 2025. There was some pushback from companies in the EU and from some of the member states actually on this. And so the EU published an omnibus. In the omnibus, they proposed to water down, if you like, the mandates. So they watered down in who was included and who was caught up in the reporting, and the timeline of when you had to report, the deadlines. Okay, so I'm not going to talk about what those criteria were before the omnibus, because I'll get confused and you'll probably get confused. So I'm just going to talk about post-omnibus stuff. So large EU companies employing over 1,000 employees on average, so kind of FTE, full-time equivalent calculation, with a net annual turnover of at least 450 million euros. However, you could also be a non-EU company who does business over there. So it's a bit like with the California doing business in. They use different language, but revenue within the EU of 450 million or more, and there is an EU branch that generates over 200 million within the EU as well. So any branches with over 200 million in the EU. Okay, so when does the reporting start? For EU-based companies, 2025 was the first reporting year for Wave 1 entries. We'll come on to what Wave 1 is in the next slide, because it's a little bit people kind of, some of these frameworks and bodies, they put companies into different buckets. So, at the top is usually like quoted, and then it might be kind of AIM listed, and then what they call large organizations, and then medium, and all this kind of stuff. But unfortunately, in all of these kind of frameworks, they're all slightly different, even within one jurisdiction. So it gets a little bit confusing, because working out what is the revenue, what is the FTE, and what are the criteria, and sometimes the criteria include balance sheet totals and things like that. But suffice to say that the 2025 reporting, which hopefully if you are caught up in that, you're already on top of, let us know if you're not. Previously, they were caught up under the NFRD. So if you were caught up under the Non-Financial Reporting Directive previously, then you're caught up in what's called Wave 1. And then for the first reporting year for in-scope non-EU companies would be, now that they've pushed it back, kicked the can down the road a bit, 2028 financial year. Okay, so with reports due in 2029. So that's given people a bit of a breathing space. And as mentioned, the requirements include quite it's quite a big ask. There's quite a lot to do. You do materiality assessment, and then from that you work out what to focus on first, and that's in IFRS S1. And climate and nature related risk and opportunities are a very big part of the CSRD. Okay, so this is just a little table to peruse in your own time. We'll be sending the decks round to everyone. Basically definitions of what's wave 1, wave 2. Wave 2 is other large EU companies, and then which years are they going to have to report and all of that kind of thing. Sticking with the EU, I'm coming on to something called CBAM, another lovely acronym, the Carbon Border Adjustment Mechanism. So what happens here is that there's something in the EU called the ETS, which is the Emissions Trading Scheme. And the idea is that you pay a carbon tax on usually kind of high carbon intensity products that you make or buy or import or do something to. And the idea is to, by having, it's a kind of cap and trade system. Cap and trade system is designed to bring all the emissions down. If you can't get yours down as quickly as someone else, you pay a bit more in carbon tax. And therefore the total is gradually brought down. That's the idea behind it. But what's happened here is that it's a bit unfair. So because there are areas where you don't pay any carbon tax, really, like, I mean, you do on electricity in the UK, because you pay something called the climate change levy. If you're not if you're just a normal humanoid, but if you're a commercial enterprise, you pay climate change levy on your electricity bills and your gas bills, and other types of fuel too. But other than that, there isn't a kind of emissions trading scheme per se. And this adjustment mechanism is designed to make it fairer for people. It's the EU's environmental policy tool for fair carbon emissions pricing. What it involves is reporting on what's called embedded GHG emissions in imports. So like it's like a thing, a product, like a lump of steel or a drain pipe or whatever. And embedded in that is some upstream embodied or embedded carbon from the manufacturer of that product. It's designed to prevent what's called carbon leakage, which is where people can get away with not reporting on their carbon because things are moving around all over the world. And like I said, it's linked to the EU ETS carbon pricing. So the tax that you would be paying is aligned to the ETS taxes level. Who has to pay this? EU importers or indirect customs representatives of these high emitting products: cement, iron, steel, aluminium, fertilizer, electricity, and hydrogen. And it starts from 2026. And people are starting to panic a bit. So from 2026, certificates must be purchased and surrendered. Now, what's happened was there was a transition phase, and I think because it was a sort of soft launch transition phase, blah, 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 it started in October 2023 and it finished in December 2026, 25, sorry, I'm getting ahead of myself, 25. And then suddenly it's mandatory. So the transition phase, companies had to report their emissions. They didn't have to pay any of the taxes. Now they do. And so now we've got to crack the whip and get on with it. So it's called the definitive phase. It starts January the 1st, 2026. Full system starts requiring. So you have to register, and importers need authorization. So they have to register on a special place on the EU's website and make monthly declarations of embedded emissions. I think it might be quarterly now, but originally it was going to be monthly. Then you have to purchase your CBAM certificates to cover your emissions, and then submit annual declarations, the first being due May 2027 for the goods imported in 2026. And then future expansion, the Commission proposed extending CBAM to more downstream products from 2028. So it could expand to more than just that list there. Now, this slide is again about CBAM, but it's to do with companies outside of the EU who export stuff into the EU. And that might seem a bit confusing because they're not the ones having to report actually really or pay the tax. But if you've got a customer, say in Ireland or France, and you happen to be outside the EU, you need to give that customer the carbon emissions, the embedded carbon emissions of the products you're selling to them. And they need to declare it, and it needs to be reported on the registry. And then they need to pay the tax. So this is where, say, for example, you could be in Scotland or Wales or wherever. And basically, what will happen is you will be asked by your clients to please provide them with this data. So what the EU has done is they've created a special portal for companies outside the EU where you can register. So you upload your data to the dedicated EU registry. Now, that's actually going to make life simpler because say you had like 50 clients in the EU, you don't want to have to send out 50 loads of data to those 50 clients. You just put it into that one registry and then they automatically access it. I don't quite know how that's going to work logistically, whether there's an API into it and they talk to each other, because it's also nascent and new. So we don't quite know. But what we know is that you can register right away now if you're outside the EU. So if you're in the UK, for example, get your CBAM number. And then what you have to do is each of the products that come into scope for this are given something called a CN code. And there's a list of codes. It's all freely available on the website. And you map your products to those codes. And then you calculate the direct and indirect scope 2 from purchased electricity embedded emissions of manufacturing those products. And the idea is that the best thing to do is to calculate those emissions of in-scope exported goods using supplier-specific factors where they're available. However, where they're not available or during the transition phase or even for the next year, you can use the default factors which are provided by the EU. So for each product, say it's like a special kind of widget for your roof or whatever it is, there will be a CN code for that product, and the CN code matches to a carbon factor. So you multiply the tonnage that you've exported by the carbon factor, and then that's it. But it includes the scope 1 and 2 emissions of the production of the goods. So that's how it works. Yeah. So
this sounds really complicated. Are we able to help people on this?
Yeah, we are. Yeah, we're at. I was actually talking to a client this morning about this, and working out how to do it, who is exporting products to the EU.
Okay.
It does sound really complicated, but it isn't really. It's like you have to register yourself on this registry, and then you have to get these numbers and multiply them together, blah, blah, blah. I think what is complicated about it is wading through there's masses and masses and masses of guidance on it. So it's like wading through it and trying to summarize it and say, okay, so this is my actual action list. So we've put together a sort of checklist, an action list of what to do if you're in the EU importing, and what to do if you're outside the EU exporting to the EU. And what's important to note is we need to monitor the future UK rules, because the UK plans a similar carbon border rule from 2027. So that would mean if you were importing stuff from the EU that's in that list, cement, blah, 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 then you'll have to pay this tax as well. Now, it's important to note that if you're already paying a carbon tax on the products, or partially, that is subtracted off what has to be paid ultimately. So say you import something from the EU post 2027, if under the EU ETS, if there's already a carbon tax being paid on that product, that will be deducted so that the total tax, make it fair, so the total tax is no more than it should be, if you like, a bit like a cap and trade.
You're not double counting. You're not double counting.
Exactly. Yeah, that's it. Yeah. Okay, so let's go APAC, let's go Australia. So Australia has the sustainability reporting standards. What is it? It's rules for Australian companies to report on their climate-related risks, opportunities, impacts, based on, sounds familiar, the ISSB standards, IFRS S1 and S2. So these ISSB standards are kind of like the rock, and then people are taking them and then maybe slightly accommodating them and adjusting them. And it hopefully is going to mean there's interoperability or kind of reporting unification across jurisdictions, so that there's some kind of homogeneous reporting. So S1 incorporates the general requirements as per S1 by the ISSB, and the Australian's version of S2 is aligned with IFRS S2 on climate-related disclosures, and it includes selected content, so as a standalone function. Who has to do this? Large listed and unlisted entities in Australia, including financial institutions. So they're doing phased entry, and they've put companies into groups based on their size. And again, it usually depends on employees, revenue, but also potentially assets that you own. And also, even if you're not an Australian company, but you're a global company, but you're listed on the Australian exchange, you also have to comply. So when does reporting start? So Group 1 is already underway, January 2025. That's the biggest financial companies. And then from July 2026, it'll be Group 2. And then July 27, Group 3. So reasonable assurance will be required from 2030. So when we talk about assurance, a lot of these schemes require what's called assurance, and there are two levels of assurance. There's limited assurance and reasonable assurance, and reasonable assurance is the highest level, and that's a way of describing the level of audit quality that you've had done. So people's carbon emissions and their risk reports, etc., are going to need to have some kind of audit from a reputable audit company from 2030. So what should we do to get ready? Start gathering the data, scopes 1, 2, and 3 emissions reporting, start looking at your climate risks and opportunities, and start looking at materiality assessments, which is looking at what is important and what is significant for your company. Okay, so I'm moving on to the UK. This is an old one, so I'm not going to spend long on this one. SECA, Streamlined Energy and Carbon Reporting. If you're caught up in this and you didn't know, you've probably had quite a few years when you should have been reporting. It's already in force, but it might be being replaced. So for the moment, SECR is the UK government initiative that requires certain companies of a certain size to disclose energy use and their scope. It's kind of, people say it's scope 1 and 2 GHG emissions. I mean, that's just a shorthand, lazy way of explaining it. It's not exactly scope 1 and 2, but that's more or less what it is. But it's energy related stuff. So it's energy related stuff. And so there is some sort of scope 3 in there to do with transport. But people that are already reporting under SECA will be aware of that. And you have to report the kilowatt hours of all the energy used, and you need intensity metrics, which means the carbon per whatever. So it could be the kilograms of carbon or tons of carbon per person, or per $1 million revenue or £1 million revenue, or it could be some other intensity measure. Measure of productivity. And then it also requires you to talk about energy efficient actions that you've done, or energy efficiency actions that you're planning to do in the next year, and ideally both. It's not mandatory to report any scope 3 apart from that one little bit of fuel that goes into employee cars. But there is a probability that when a new framework takes over from this, which we'll come on to talk about in a second, then Scope 3 will be included. Who has to do it? Quoted companies, as well as large unquoted companies. And the definition of large for this is 2 out of 3 of 250 employees, 36 million pounds turnover, 18 million pounds gross balance sheet. So 2 out of 3 of those. A lot of people have to do this. A lot of companies have to do this. And as mentioned, it's already underway. So here we go. On to the next UK one. So ESOS, the Energy Savings Opportunity Scheme. The qualifications for ESOS are very similar to those of SECA, annoyingly slightly different. So it's, instead of saying 2 out of 3, it's like you have to either have qualify because of the 250 employees, or you qualify on a financial basis, and the thresholds are slightly higher. So 44 million for your turnover and 38 million for your balance sheet. And the rules are slightly different because with SECA, say you're in a corporate group, only those subsidiaries within the group that qualify within their own right have to report SECA. But when you come to ESOS, if one member of the group qualifies, the whole group has to report. So again, it's the semantics of all of this. So what do you have to report under ESOS? You have to do audits of your buildings. It's looking at energy and it's looking at savings opportunities. You have to appoint a lead assessor, an ESOS lead assessor, and you need an ESOS team usually. If you've just got one site, then just one person can help you. A lot of our clients have very many sites. So what you do is a sampling approach, and you put all the sites into different groupings according to the spec of the buildings. So the age of them, whether they're cellular, whether they're open plan, all of this kind of stuff, the structure, the materials. And then you can do audits just on one representative building that represents that whole sample set. So you don't have to audit like 150 buildings, but the audits are quite thorough. And out of those audits come recommendations for savings. And the recommendations for savings need to be costed, they need to be realistic, they need to be apposite to your specific building and how long your lease is and all of that kind of stuff. So ESOS is designed to be useful. It does come with some rather heavy penalties if you don't comply. But my experience has always been, up until now, famous last words, that the government or the ESOS department within the government prefers you to comply than to fine you. They don't really want to slap a £50,000 pound fine on you. What they want you to do is do the audits and reduce your energy, because that's the whole idea. So if you're late, don't hide under your desk. Just pop your head up and knock on someone's door, the government ESOS department or 51 to Carbon Zero, whoever, and just comply, and you probably won't get fined so long as they can see that you're doing everything you can to comply. It runs on a 4-year cycle. They keep adding more and more stuff. So ESOS Phase 3, that feels like we've only just finished it, but it just ran on and on and on and on. The deadlines got put back and back. There are some changes coming up with ESOS Phase 4. It's becoming more thorough, and there'll be more audits of lead assessors' work, things like that. So it's not going away. There are key dates for ESOS Phase 4. The qualification date is the date when you decide whether you're in or out of the scheme, and that's the 31st December of this year. And then the compliance date for Phase 4 is the following December, the 5th December of 2027. So we're already in the reporting window for Phase 4. What should you do? Check if you qualify and track your financial performance against the ESOL threshold, so that if you think you're quite close to the threshold, keep an eye on it, because you might tip over. But if you only just tipped over for the first time in phase 4, you wouldn't have to comply, because it's 2 out of the last 3 years that are taken into consideration to make it a bit fairer. And then make sure that you have a checkpoint. 31st December 2026 is the qualification date. Engage an ESOS lead assessor, probably sort of second half of this year, probably to get cracking, and then be ready to kick off your audit if you're in scope. Okay, so we're moving on to something called the sustainability disclosure requirement. So this started life way back under the FCA, which is the Financial Conduct Authority, and then in 2024 under the Conservative Sunak administration, they were going to roll this out to encompass more companies and not just financial companies. But then it all kind of got mothballed for a while, and so we don't quite know where we are with all of these things. I've done a little drawing here to show how the sustainability disclosure requirement is made up of 3 separate components. The most important one I would draw your attention to is the sustainability reporting standards. The other 2, transition plan and the green taxonomy, are, let's say, less impetus is being put on those, and they're likely to be, if they become mandatory, there will be fewer types of companies that are caught up in them, put it that way. But the sustainability reporting standards is more likely to be a generic thing, not just focused on financial companies or listed companies. So it's an overarching UK government initiative, and the whole idea of it is focused on financials, is anti-greenwashing. So it's to do with the UK government's green finance strategy to create mandatory sustainability reporting for UK companies. So, you know, that thing where it goes, oh, here's a green mortgage, here's a, you know, really nice fluffy bond you can buy that doesn't do any harm, or kind of climate positive, you know, I don't know, equities or something. It's sort of a bit like the green claims code for products, but this is for financial instruments. SDR is the main disclosure requirement. That PS 2316 is the name of the piece of legislation. I think it's like the clause in the Companies Act 2006. And it applies to UK registered asset managers with UK domiciled funds. So that's where it's, if you're not financial, you're excluded. The SRS, sustainability reporting standards, we'll come on to those in a minute. And then you've got the Transition Plan Task Force. The Transition Plan Task Force, so the task force was actually a group of people, just like TCFD was, you know, an actual entity or group of people, but they created a report which was the gold standard disclosure framework for how companies can plan their transition to a net zero economy. It's currently voluntary, but it's the gold standard for a transition plan, so worth looking at. And then the UK Green Taxonomy, classify and report sustainable economic activities in line with regulatory definition. So that's where the taxonomy for what you can say about the greenness of your products is defined and set out. So let's move on to SRS. SRS is the Sustainability Reporting Standards. The UK endorsed standards based on, guess what? IFRS S1 and S2 for investor grade sustainability reporting. So you've got the 4 pillars, your governance strategy, risk, metrics and targets. And the whole point is to streamline UK reporting requirements such as SECA and align with the ISSB international standard, S1 and S2. Who is it for? Well, it hasn't come into play yet. We don't know exactly, but it's likely to be for UK listed companies and large private companies, but we're not quite sure about the thresholds because it's not set in law. And it's very likely to be a phased rollout. And when might that be? So the government response and final standards expected this year. Possibly mandatory phase-in between 2026 27. I have a feeling it might be a bit later with everything that's going on, but that's probably the way to plan for it, the way to think of it. And the earliest possible reporting year for private companies in the UK would probably be 2027. What should you do? So again, this is focused on generic sustainability reporting, which is S1, and also your climate related risks and opportunities, which is your S2. And for both standards, there are the 4 pillars. To monitor progress of the SCA and the UK government's SRS endorsement. So they're going to either endorse or not endorse the SRS imminently, I believe. And then meanwhile, continue your reporting under SECA and NFSI, where companies qualify. NFSI, we haven't come on to yet, so let's come on to that. That's not the next one, but we will.
Just to let you know,
yes.
We've got about 10 minutes left.
We've got about 10 minutes. Okay, I think we're on track.
Good.
Okay.
Perfect. Well done.
Let me, actually, yeah, let me speed up a bit. Thanks, Will. That's helpful. So the Transition Plan Task Force, I will just zoom through this one because it's not actually mandatory. And I've already just mentioned that this is to do with writing a gold standard transition plan to net zero. There are 5 elements to it. I've listed them here on this slide. And what you're encouraged to do is align with the framework proactively to prepare for future obligations. But it is worth, like, if a transition plan is a really important thing to have for your company's health and to manage your company's risks. So having a look at the Transition Plan Task Force framework and standard is a really good idea. Okay, so I mentioned the NFSI. Now, this is a clause in the Companies Act 2006, and this is where some companies in the UK already have to report TCFD aligned climate risk in their annual report to the directors, or what's called the strategic report. And I've put there TCFD / IFRS S2 because IFRS S2 has taken over responsibility for it, if you like. Rather, it hasn't taken over responsibility for it because it's a framework, but it's shifted from TCFD being the kind of name of it to IFRS S2 being the name of it. The government is looking at which bits of the S2 standard they might water down or add to or change slightly, but pretty much any changes are inconsequential. It's pretty much going to stay as it is. And S2 is pretty much the same as TCFD was. So what is NFSI? It's non-financial sustainability information, and the S at the end is the statement. So you make a statement in your report. Again, we have the 4 pillars: governance, strategy, risk management, metrics and targets. And the metrics and targets include your scope 1 to 3 emissions, your science-based targets or non-science-based targets, whatever targets you've got, and your transition plan. Who has to do it? So it applies to UK companies and LLPs meeting the statutory thresholds, which are more than 500 employees, so that's full-time equivalent employees, and either you're trading listed, AIM listed, or private companies with a turnover over 500 million. So that's caught up a number of clients of ours that have to do this, because you could have a much lower turnover but be AIM listed, etc. So when does reporting start? It's already in place. It's been going for a while. What should you do if you find that you haven't been doing this, or you realize that you're now becoming a public company instead of a private company, so you're going to be caught up in it, etc. So usual thing, start measuring your corporate scope 1, 2, 3 emissions, set your net zero targets, do a roadmap, and then start doing your climate risk and opportunity assessments across the business. Create your climate risk management strategy. And then, as we were talking about the process, the committees, responsibilities, the key stakeholders, how often they meet, what the procedures are. So there's a kind of qualitative aspect to the NFSI, as well as a quantitative thing, which is the actual risk matrix itself. Okay, I'm now coming on to voluntary frameworks, and I'm going to mention two. One is the Science Based Targets Initiative corporate net zero standard. So what is it? It's a voluntary thing, but since the first time we got a company through back in 2019, it's massively grown, and also a lot more frameworks have been published, which are in industry specific by the SBTI. Everyone calls them the SBTI. So it's quite big. You're probably bound to have heard of it, even if you haven't actually signed up. What's the net zero standard? It provides companies across the globe with a clearly defined pathway to set targets in line with the global target of limiting global heating to 1.5. Well, good luck with that. We've already blown that one, but we can still keep going because we want to claw it back. So it was always with low or no overshoot. I think no overshoot has gone, but we would like to keep it with a low, not very long lasting overshoot by 2050. So what's involved? Under the corporate net zero standard, let's call it CNZS version 1.3, and that's key. You measure your footprint, you develop your targets, submit for validation, public disclosure, and annually report. Now, science-based, what it means is that using a load of scientists and reports and studies, what the initiative has done is work out what each of us needs to do as a company to play our part of keeping global emissions below a certain level that has got a high likelihood, or at least a 50% likelihood, of not tipping us over the temperature limit that has been, by the IPCC has said we mustn't go over 1.5. So the SBTI splits your targets into near term and longer term. Near term, the short term reduction goal to set you on a pathway to net zero, and that's usually up to 10 years. And then long term, your net zero target, which has to be by 2050, requires 90% of emissions reduction and removal of what's called your residual. Residual is the up to 10% bit that you haven't been able to scrub out. Why would you do this? It demonstrates robust decarbonisation commitment rooted in the latest climate science with genuine carbon reduction. And yeah, up until version 1.3, it's looking at genuine carbon reductions rather than use of carbon credits and stuff like that for, you know, those sort of early claims of net zero that people were making that were based on offsets. And then just to mention that, because we work with a lot of food and beverage people, food and beverage and some other industries that are aligned to stuff going on the land are required to set FLAG, which stands for Forestry, Land and Agriculture Targets. There's a little bit of a delay around that, although the FLAG guidance from SBTI has been around for a while. The GHG protocol standard is yet to be finalised, and it has been put back a lot. But the reason for that is it's very complicated, and they're trying to get it right so that you can actually, the practitioners can actually use it, and it's not kind of a huge academic paper that is too difficult to make sense of, and lots of other things. But it's designed to look at land use change, and it's designed to stop deforestation. That's the whole gig. Now, the current CNZS version 1.3 is under review. A new standard version 2 2 is under consultation. And this is where we come to version 2. So this has got a lot on it, this slide, but the key changes are that the target types will include alignment as well as linear reductions and intensity reductions. And then the engagement targets are going to be more prescriptive. So they're going to be to do with influence that you have over your suppliers and your value chain rather than more kind of loose. Also, it was always the case that you set your scope 1 and 2 targets together, and they're now going to be separate. You will set both location-based and market-based or zero carbon scope 2 targets. And there will be tighter renewable energy certificate criteria, or REGOs as they're called in the UK, Renewable Energy Guarantee of Origin. So they're tightening that up and making them more pertinent to your actual real situation. Scope 3 boundary shift from percent coverage to category significance, intensity and influence. So that's a big difference, because it was always the case that you had to have 67% of your scope 3 included for your near-term target and 90% for your long-term target or your net zero target. That's changing, and they're going to look at each scope 3 category individually. And if it's over 5% of your total scope 3, then you have to include it. So that's different, but also there are other aspects to it because of the emissions intensity of that category and the amount of influence you have to reduce it. So it's designed to focus attention on the things that are the most important because they're the most emitting and they're causing the most damage, but also those categories that, over which you have the most leverage and you can actually do something about. So they're trying to make us hurry up. You also need to have a transition plan. And people always said, oh, you can set this target, but you don't have to have a plan how you're going to get there. And that's always been the case. Now you're going to have a transition plan as well, and a structured reporting life cycle. Okay, and here's something very big. It's going to introduce something called EACs. Now, these are not the old EACs, Energy Attribute Certificates, which is a kind of generic term that includes RECs and REGOs. This is something that is new to me, environmental attribute certificates. And that includes carbon credits. And they will be allowed to be used against scope 3, albeit with guardrails and very strict criteria. So this is a major shift. Scope 1 changes are not that massive. The second draft, so we're in the second draft of version 2 standard, by the way. And at the moment, the idea is to continue setting targets and updating targets and reporting under the version 1.3 that's out there at the moment. So if you've got an existing target, you carry on. If you want to set a target right now, you use version 1.3 and just keep going. But in the meantime, the second consultation, version 2, has just finished, and then that will all be rolled up and rolled out as this year unravels. So reducing emissions on a linear pathway to net zero, increasing the share of low carbon activities over time, and implementing something called asset decarbonation plans. Those are the changes to scope 1. Scope 2, so as mentioned, you set a location-based scope 2 target, and then either a target to reduce market-based scope 2 emissions, which is where your specific tariff is taken into account. So you use your supplier-specific factors and the fuel mix from your supplier rather than from your region, or a zero carbon electricity target. So that replaces the old electricity target that you could do that was sort of in addition. Criteria for use of decarbonisation contractual instruments is strengthened. So that's where the RECs and REGOs come in. And what's going to happen is they're going to be temporal and geographic matching of the certificates. So instead of going out and buying some brown energy from some random supplier and then going and buying some certificates off the wholesale market and going, there we go, they have to be matched so that the actual electricity you're using is as close as possibly matched by the certificates that you're applying to them to show that you're buying renewables or that you're buying low carbon energy. Exactly how that's going to happen in practice, we don't know, because obviously this is still draft. Changes to scope 3, as mentioned, the boundary is changing. So it's instead of a straightforward percentage of the whole of scope 3, you look at individual categories and measure whether there are a significant over 5%. It permits value chain linked environmental attribute certificates under strict conditions for hard to abate sources. Hard to abate. So let's see what that exactly turns out to be. And then alignment targets, introduce non-emission metrics. So this is the first time that you can have targets that are non-emissions, and it's to do with alignment. I've seen this before in the financial industries where you have like a tracker bond, like a perfect, green bond, and you try and follow it and you get closer and closer to the carbon intensity of that bond. So this is a similar thing where the share of procurement from net zero aligned suppliers and activities or share of revenue from net zero aligned products and services is the measure. How are we doing for time?
We're close to the ends.
Close to the end. Close to the end. This is perfect because I've got, I think, one more slide after here. So this is just a summary of the differences between the CNZS version 2 proposed draft and version 1.3 scope 3. It's just a nice little table so that you can see what's going to change all on one slide. But I won't go through it, but it's just something that can be nice to have as a reference document. And then just finally, voluntary framework, the task force on nature-related financial disclosures. So why would you do TNFD? It goes beyond climate and it goes beyond carbon to cover other aspects of nature that organisations may impact, giving completeness to your environmental sustainability approach. Now, it's more pertinent now, perhaps, than it was because people are more aware of biodiversity and all the other, pollution and eutrophication, acidification, land use change, deforestation, all of these things. And also things like CSRD are asking us to report on those as well. So we're having less of a monocarbon view of things and expanding out to include other aspects of nature, not just carbon emissions. It's a global initiative that provides a framework to enable businesses to assess, report, and act on their nature-related dependencies. So things that you depend on and also things that you impact, and the old risks and opportunities again. And funnily enough, it follows the 4 pillars: governance, strategy, risk and impact management, and your metrics and targets. If you do report under the TNFD, you'll go a long way to being compliant with the CSRD IFRS S1, sort of the nature part of that. So it is recommended. It is a good framework and it's been around for a while. And I think that's brought us to the end. So this is just a slide about 51 to carbon zero. Do you want to say anything about that, Will?
Yeah, brilliant. That is just really, really useful. Thank you so much, Emma. I think that what you highlighted, I mean, a lot of the legislation that is coming through, be it California, Australia, EU, UK, it's kind of all doing the same thing, isn't it? Yeah. And actually, if you look at it practically, we're seeing many more climate disasters happening around the world, and we've got to have a business as usual backdrop, and we've got to have business continuity planning on the back of those frequent disruptions that we're going to have through logistics, in the data centers, in offices and critical suppliers. And you've talked about all of that through. And interestingly, on that last couple of slides, you talked about data sets, and climate risks is getting better, and we're getting more granularity, but we really need to be integrating these data sets into your site strategy and your overall procurement. And it's it's almost warming to see how much legislation is out there and how pertinent it is to business, because I think that we can become quite kind of another legislation, but if you understand the backdrop of it and why you're doing it, then we really should be reporting quite concisely and more. And that's where 51 come in. We can really help you with that reporting, getting those data sets really robust so that you can reduce and you can eliminate that risk and understand your business way more. So
yeah, definitely.
You want to get in contact with us, our details will be in the notes. I was going to say the show notes, in the notes. And so thank you so much and enjoy the rest of your day.
Thank you.